Well, good day, all. I'm Epstein, and here we are on Tuesday, and we are sitting here now, March 28th, 2023, about 4:55 in the afternoon. So, as we look at the markets, you got a mixed bag here of red and green, markets fighting for direction in different spots. Now, one of the areas been getting hit is the tech area. And the reason for that happens to be that the market is shifting its thought process away from the idea that the banking system is coming unglued to the idea that, no, it's not systematic. There's nothing wrong with all regional banks or anything. This was the first group of mismanaged banks. Did you listen at all today to the hearings that went on in Congress questioning the head of Mr. Barr, William Barr, the head of the banking supervision at the Fed? You got the head of the FDIC there and so on. It's pretty unanimous. Mismanagement of risk. I think I said that to you when it was going on. Don't these people know how to hedge? Amazing. Why don't they hedge? Because of the cost of it. And that means that it cuts into the profitability, and maybe, just maybe, things won't get worse. You cross your fingers, you hope, you light candles, and they go out. I don't know what else to say. And they went out for these banks. Now, are there other banks in problem? For certain. Are those banks, if they have any brains about them, whittling down those problems in every way they can to lock in things? One of the things that just happened is you broke the short-term rates over a full point. You could have come in and put some hedges on because the Fed isn't through yet. All right. Now, you may think the Fed's through. I don't. I think that if another shoe doesn't drop out of the banking, that the Fed says, okay, we pushed it, we broke the system, but we didn't break the system permanently. We glued it. We figured out what that is. But did it really have to do with us raising rates that we have really told everybody are coming, or those banks mismanaging what we said? And I think it's the latter. And because of the latter, by the way, I'm not an expert enough to know exactly how they should have hedged that, but I can tell you, if the Fed's telling you they're going to keep raising rates as they've done now for over a year, why are you doing anything long term? And the bet has been that the 2-year, 10-year would invert. I was here in June, I can prove it, it's on YouTube, saying I thought it was going to go to 100. And the spreads then were about 40. They're back to where they're at, by the way. So there were hedges available then, for sure. And that could have done it. You could have trimmed portfolios and said, no, I don't want to own some of this other stuff. Let's get rid of that. We've got to be more liquid. What will a 6-month money bring us? There's different things that are available to banks. And those were out there. And banks that stayed liquid don't have these problems. Smaller banks that went to make the kill have these problems. And banks that are prone to get runs on deposits because they have what's called hot money. That's another one. Hot money being, I'm in tech, nothing's going on, I got to move my money somewhere else, I've got to put it to work, whatever the deal is. And that's what happened to a degree. They're going to go after a guy like Peter Thiel. I hate to say it, he's a great VC, but he was the name out there telling people that was in all the press, got to move money out of there. I want my company's money moved. So will they eventually go after him? I don't see how not. Did he cause a bank run? Absolutely, in my opinion, not. He gave a warning. That is not a run. It's what he wanted his companies to do. Could they make more out of it? You never know. I'm just giving you my thoughts. I could be very wrong on what I'm saying, and I hope I am. So, in Disney, there's problems. They're letting 7,000 people go. Today, we're hearing other firms, another 1,400 from another firm, a big firm today. So as these people let go, the idea here is to cut the bottom line cost, right? We're not talking additional revenue. We're now into cost cutting. Meta's been doing this for a while, as you know, and people are falling in love with Meta because of it. So the core products are good. This is a great company. So that's what they're going to do to follow that lead. And there's others that will continue to follow suit. The key is, and I'll give you the key, it has nothing to do with Disney. What do those 7,000 people do? How fast do they get new jobs wherever they're going? They don't all clean the park. There's animators, there's tech people, there's so many different skills that are coming out. Where do they land and how fast? So you keep your eye on labor. Labor is everything right now. Inflation is getting weighed down because of more supplies, the supply chain being full again, blah, blah, blah. What isn't done is where is the peak labor? We don't know. Normally, you'd have said 3.6, 3.5% unemployment is peak labor. Frankly, 4% is a comfortable number for guys like me, but that's not quite what happens. So you've got to wonder just how does that all play out. So let's go to the very next part. If you look at Disney here, we have patterns of what? Higher lows, higher highs. That's still bullish? No. You've got higher lows and lower highs. You've got a neutral pattern right now. The market is also fighting moving averages. So it's had this rally back up to the 18-day moving average, and it stopped. Just stopped in its tracks. But you have the swing line up, and you've got the bias down. Something's going to give. I don't know which way. The chart isn't telling you. When we take a look at Bollinger Bands and you come back here, look at where that Bollinger Band, where you fell to. If you don't learn how to work with Bollinger Bands, shame on you. But it's not just the Bollinger Band. It's what happens down here with the slow stochastic as it comes out of being embedded. Do you even know what I'm talking about? If not, at the end of this video, I'm going to bring up my Bollinger Band course. Please, I beg of you, learn. That's all. Learn. If you don't learn, shame on you. We then get to Schwab. Now, what I'm reading about Schwab, I'm not liking. This well-run firm has too locked in a bunch of, apparently, monies for some of these rates that aren't the best rate that it could have gotten. And that is why you're suddenly not getting the bounce out of it. People think there could be some problems brewing here. I don't know enough about how they run their brokerage company. I know that when I ran mine, interest was a big, big component of what you do. You understand these companies. You're paying zero commission. Where do you think the money's being made from? A certain amount of banking, a certain amount of investments of your money that they're keeping. They're not going to pay you what they earn. They'll give you something often, but not everything. And that is going to hurt. If people start wanting their money back, if they do, could it cause a run on a company like Schwab? From what I'm reading, it can create definitive problems. We then get to the market that I think is sticking its head out and telling you it's spring, it's summer. We're going driving. And this market is come alive. I don't think you're going to visit this low again. I think the market's going to try to come back up. Next, we go into a company like Tesla. Lower highs, lower lows into support. Close under that 18-day average of closes and problems start coming in for this. Now, Tesla's got one thing that others don't. It's got market share. It's got profitability in cars, which I like. And even if it loses, it doesn't lose what the other manufacturers trying to develop, GM, Ford, I can go on and on, Mercedes, what it's going to cost them to develop electric cars compared to what Tesla already has. But like everything else, it's a commodity. And if you want to keep market share, you lower price. It's smart. It hurts the people trying to compete with you. Their loss suddenly gets bigger. You may make less, but you're really hurting them. You're doing a job digging that hole in the arm. And we'll see how much and how far they go. In XLF, I am looking at this and I'm saying to myself, what is the the slow stochastics doing? As long as these numbers don't close over 21, it would appear to me that the financial services still on this rally look weak. We'll see if I'm right or wrong. Close over 21, I got to close my idea of being short that market. Until that occurs, I happen to like it. Then we get to XLI, and as you can see in this particular chart, you got one number at 30, one at 25. You have an oversold market. It made its play. It got down here, back here to the 200-day average in the Bollinger Band. Then it fell, I'm sorry, that's the 100-day average. Then it got down to the 200, grabbed and moved. Watch the 200-day average all the time. Now, why are we suddenly selling off NVIDIA and others? I wish I could tell you other than to say, if the Fed turns its attention back to what it should, fighting inflation and this banking situation, I'm not saying it's in our rear view mirror, I'm saying there's no more of it. Maybe that's the better word. Well, then these companies, tech companies that rely on low interest rates are going to pay up again, because the Fed is not through. I am not in the camp that thinks the Fed is through. I know that people are saying, well, the Fed caused the problems at SVB and Sovereign and so on. No, they didn't. No, they didn't. They telegraphed what they were going to do. The problems are caused not by the Fed. The banks mismanaged things. That's my definition of what went on. But the system got fragile. How much can it handle if the Fed goes up another quarter point, a half point? Do I think the Fed would go up a half point anytime soon? Absolutely not. I think they'll use prudence. If they feel they have to go up, they'll go the quarter. We'll know more as the data rolls in. XHB, so as we take a look here, why not come back up? Mortgage rates have fallen. But you're caught in that sideways action. And when you get to this sideways action, don't be a hero. On the energy sector, you're coming up because you've lost 450,000 barrels a day of oil in Iraq. Yep, the northern region, which is run by the other factions of the government that don't recognize, if you will. Well, they recognize them, they won't succumb to the authority of them. They're at least not fighting between the two physically. In 2012-14, they filed complaints against each other. Tribunal, not theirs, but a different tribunal that Turkey's also part of, listened to the case and ruled against them this past week, which means their oil cannot go through the pipeline without Baghdad's approval. Baghdad isn't given that for anything free. Think of the word royalty, royalty. That is the way you resolve it. If Baghdad never gives it to them, then you probably have a civil war, because people that have that oil and they can't ship it, they're going to fight. They'll get desperate. So you got to work something out, in my humble opinion. Gold's market. So the gold's looking at even higher interest rates than what the Fed is doing, and it's not worried. It bounced today. The market's trying to develop an embedded reading. Silver's got it. Silver's where the strength is in these markets. So SLV, the miners for that are good. Copper market. Copper is counting so much on China right now. But the chart action is bullish. You got higher lows, higher highs. So on pullbacks, until you take out the most recent low here, I expect this market to work higher. On TLT, as you know, that I'm now saying to you, they're putting premium back in because the banking crisis is over. So you had this big run up off the banking crisis, and now the market's finding its equilibrium again back down, because that's come and gone for the moment. For the moment. I don't know if it'll show up again. In UUP, well, the dollar's still looking to me a bit bearish, as the FXE is looking a bit bullish. One's overbought, one's a little bit oversold. You put it together, you come up with a game plan. What is the game plan? Well, for me, for you, it's learning how to work with what I call the enhanced Bollinger Band course of embedded slow stochastic readings with Bollinger Bands. Take a look at this. The best thing you could do is educate yourself. Welcome. I'm Epstein, and I'm here to talk about my enhanced Bollinger Band course. Now, many of you have taken my regular charting course, and if not, you might think you know something about Bollinger Bands. As you know, Bollinger Bands are an algorithm designed to keep the market trading within it 95% of the time. And on a chart, it will offer on the top part resistance, on the bottom support, and the idea is the market will travel within them. We know that sometimes it latches onto that band, goes up or goes down. Well, how do you play with that? Can you pyramid the positions off that type of thinking? Well, I've applied all 3 of these into 13 different videos that teach you my concept of it. And from that concept, you're able to work with weekly charts and or daily charts. The 13 videos, each about 7 minutes long. The idea here is not to put you in school forever, but to teach. Now, if you haven't tried my complete futures research, I throw that in as well. Whether you've tried this or not, I think it's worth taking a look at. I think you're going to learn something from there. That research, by the way, covers twice daily market updates for you and access to what I call window envelope numbers, which I think are very important when looking at these Bollinger Bands. The next part is a trial to our charting software so you can make your charts look the same way that mine do. It's that simple. Where do you go with it and how do you get all this? It's simple. You go to our website, www.iraepstein.com. If you go to the word education, everything you need is answered there. You can also call my staff. They'll be happy to help you get set up. I'm Ira Epstein on the road to your education.